you may know this, some of you may not, so I wanted to at least mention this today. But last year, Chris and I did an obstacle course race.
Yep.
And it's called a Spartan Beast. It's about 15 miles in length, 30 plus obstacles between this 15 miles. And these obstacles, they can range from monkey bars to rope climb to swimming in a lake,
Mud under
wall,
barbed wire,
dunk wall, lots of fun stuff. The kicker is, if you can't complete the obstacle, you have to do either 30 burpees, and I don't know if everybody knows what a burpee is. We won't demonstrate. I was going to say 30 burpees. It's kind of like a push-up, right, where you jump. Or you have to do extra running, so like basically a penalty loop. So we actually had a blast. You guys are probably sitting there saying, my gosh, it sounds terrible. It doesn't sound fun at all. But we did. We had a good time. But what's interesting is when it's about 2 or 3 days before the race, they release a map, like a trail map or a course map saying, okay, here's kind of what to expect. It lays out, okay, what type of obstacles, where are they at in the race, where do you get this one, where do you get that one, what's the elevation gain, what's the terrain look like. And as I was thinking about, what we're going to be talking about today, which is the markets, and really what we're expecting moving forward into this year, I thought a lot about how similar this really idea is to us looking at the course map, and trying to say, okay, here's where are the obstacles, where are the potential pitfalls, where are the things we have to prepare for in the time that we have. Now, I know we've got this picture up here. But.
Yeah, well, I thought the whole reason of the picture was the guy between us. I don't know if you see when we're trying to find a picture, this is the best picture of the two of us, and there's the shirtless guy between us. So for your enjoyment today,
whoever that is, we're sorry. But
I will say, just as a quick aside, and I think that's a great illustration. We got some planes flying over us right now. The other big difference in this race is 15 years. Is that right? Age difference, something like 15, that. 13 years, 15 years age difference. And I will tell you, that difference in 15 years is a lot. That gray hair in that picture that you see was earned. Brown hair, it's just not fair. But I think what we're going to see is in this market, there's going to be some of those things where we're going to have some aging themes as well. We'll call those Chris themes. Yeah. And then we're going to have, really with kind of the change of administration, we're going to have some more what we'd consider youthful changes that are going to be, going to have some interesting energy behind them.
Yeah.
So let's dig in.
Yeah, let's do it. So we talked about it, but want to talk a little bit. I'm not going to spend a ton of time on last year. I mean, we all know what last year was. I do want to talk a little bit and spend some time though on really what drove market performance, because I think we can look at that and we can learn some lessons from last year and in hopes of improving and looking at what we're expecting this year. So we'll look at last year. We'll talk about that a little bit, dig into what we're expecting this year, and then really what kind of our forecasts are as we move into 2025. So how did stocks perform in 2024? Well, we all know S&P, did pretty well last year, and really did quite better than what analysts predicted. And so, again, we're not going to spend a lot of time on this, but a lot better than where the analyst projections came in. And, again, I think we can learn some lessons around where the disconnect was and what people thought and what actually ended up happening in the markets.
And I think the important thing, and we've talked about this before because we've shown that slide that you just had up there before, when we talk about the talking head experts at the beginning of the year, as somebody that's been on CNBC and Fox Business and all those different things, I will tell you, they oftentimes are looking for people that are simply having a voice and opinion. But oftentimes, if you can back that up, I mean, you can see at the beginning of the year last year, the group average expectation for the S&P 500 was going to be to end the year at 48.17, and it ended up at 58.81. I mean, talk about being significantly off in the expectations. But I think that's somewhat of the danger of kind of taking a stance at the beginning of the year and saying, okay, this is exactly what the year's going to look like and how we're going to go forward. It's the reason why at times we need to pivot. Now in this case, we got to see things go very positive.
Yeah.
Other times we can see where people are excited at the start of the year, and it can flip because either things that are in control or oftentimes things that are out of our control.
I think a lot of this, the outperformance, kind of speaks to what we've talked a lot about on a lot of the stuff we've done together, Chris, which, is a small subset of the market, especially in the S&P, is really what's been driving returns. And so when you look at, the Magnificent Seven, which is what everybody talks about these days, that has done very well, that subset.
And what are those?
Those are your Apples, your Microsoft, Google, NVIDIA, the big players, really mostly tech focused. But now we're seeing their valuations very, very high. But if you look at the equal weighted S&P, or you look at the broad market kind of X Magnificent Seven, the valuations are not what you would think. It's pretty surprising, actually. All right, so let's get into market performance in 2024. So I want to spend a little bit of time talking about the S&P. So this chart that we have up here, right here, is basically just outlining from start to finish in 2024 what was the movement of the S&P. And I just want to spend a couple minutes, or maybe not even a minute or two, on this slide because it's very interesting in that there's a few key points in time that I wanted to highlight. We saw inflation at the beginning of the year. It was still rearing its ugly head. I mean, we were still seeing year-over-year CPI of over 3%. But as we see kind of how things transpired moving into the second half, or the first half of the year into the second half of the year, we saw the kind of forward-looking aspect of the markets in that inflation in July hit a low, a 3-year low essentially, and the markets had kind of already priced that in. We saw some volatility, in the August timeframe. But then we really saw some momentum when we saw the Fed make the first cut, 4 basis points the first 50 basis points, the first in over 4 years. And that really kind of bolstered the market forward, along with once we got the election uncertainty as well out of the way.
All right, let me give some clarity because I know some of you understand what basis points are. When you hear 50 basis points, that's fancy tech talk. That means 0.5% or 0.5%, okay? So if you ever hear 100 basis points, that means 1%. I know there's mathematical reasons, but I firmly believe it's an attempt by the financial industry to make our world seem much more mysterious and confusing. And it tends to confuse a lot of folks.
Yeah. Well, it's funny. I like to think about, when we think about rate cuts, it reminds me a little bit of being on the trail, running that race. And you're tired, you're halfway through, you're slushing through mud, and you take those energy gels, they're Goose, is the brand that I use. But you take that energy gel and you get kind of an energy boost. And that's kind of what rate cuts did for us, especially in September. It gave the market a boost, is really what happened. I'm not going to spend a lot of time on this slide, but really what we're looking at here is just growth in earnings. And we really saw earnings beginning to accelerate kind of middle of 2023 into 2024. And I'm going to come back to earnings as we get a little bit further along, because earnings and earnings expectations, that is really key this year. And again, we'll dig into that in a little bit, but that is one area that we need to be paying close attention to when we think about where markets could go moving forward. There's a lot of numbers here, and the only thing that I wanted to mention in terms of last year, economic indicators that are really important, you guys probably know this, but GDP growth, growth in the economy, which is just goods and services, that are produced in a given year or quarter or whatever time period we're measuring. We saw some really good movement in GDP last year, and especially, the middle quarters, your Q2, Q3 was really robust. The unemployment rate, jobs, continues to be a resilient market. And we saw really a consistent, pretty consistently low unemployment number throughout last year. We're beginning to see some signs of weakness in the labor market, and we'll talk about that as well in a bit. And I think the last thing here on this slide, inflation. We saw inflation, especially towards the end, Q3, Q4, beginning to lower, and that had it was a big reason why we saw such a good performance number in the S&P last year.
I think the important thing to think about with inflation too, sometimes we hear that inflation's lowering and we all go to the grocery store and we say it sure doesn't feel like it. And when we hear inflation's lowering, it just means that the rate of increase is decreasing. It's not the actual prices are decreasing, if that makes sense. Sometimes when we hear that, I know some people have kind of been confused and they say, boy, I keep hearing that inflation's going down. That just means that it's slowing down. Prices are still going up, just at a slower rate. Don't confuse that with deflation. And deflation is when we start seeing prices actually go down, which...
Yeah. Well, and I think inflation, we'll talk about it a little bit, but inflation has been pretty persistent in that, the Fed's target is 2%, and that's really what, they're shooting for. But getting that 2% level is proving to be difficult. It's kind of, we've talked about it, we've sort of expected it to be a little elevated, but yeah, we feel it when you go to the grocery store. Gas pump right now is not too bad just with the way energy has been, but it is out there.
Yeah, and a lot of that's driven by, and this is actually what I talk a lot about in the weekly Wealthologist this week, is it's driven by the Fed printing money. We're obviously at the tail end from, we're removed from the pandemic and everything, but the one thing that we can look at is there was a lot of money printed during the pandemic. We increased money supply by 40%. And when you add 40% new money to the system, inflation happens. It just happens. Yeah. And we're still not out of that. There's still a lot of money kind of sitting out there that's kind of getting sopped up. The good news is when we start seeing those inflation numbers change a little bit, it is showing that it's not obviously at that same level that we saw before.
Right. So you guys have seen this before. We actually talked a little bit about, I call them speedometers, and we looked at this last year. But this is really, really cool in my opinion because it allows us to see kind of snapshots in time of different indicators that point to either positive, negative, or neutral impact on investments. Now this is measured in a shorter time period, so about 3 to 6 months, so understand that. But what stands out to me, January of 2023, we had, some red on the board and really mostly red and neutral in terms of outlook. And, monetary policy was pretty negative as far as impact on investment. We had geopolitical risk at the time. And again, a lot of neutral sentiment based on January of 2023. Now, if we fast forward 1 year and look at January of 2024, what stands out to me here, it's less red, but a little bit more neutral. Neutral in terms of, again, these indicators, geopolitical and equity market valuations still somewhat red in that respect, but a different picture than the year before. And when we look at this year, January of 2025, again, I think what stands out to me is more green than we've seen in either of those two pictures. Now, you can kind of take that one of two ways. Sometimes my contrarian kind of nature says, oh, should I be a little, concerned about that? We'll see. We'll talk a little bit about that. But, again, we see monetary policy being positive. We're looking at probably 2 rate cuts this year. I think we're probably going to see 2.25% rate cuts. Chris, you mentioned inflation, but also consumer spending and really strength of the consumer. We've seen a pretty resilient backdrop for consumer spending. It does account for, really an overall majority of economic growth.
70%?
And, yeah, about 70%, 2/3 or so. And that has been, showing positive along with kind of a resilient labor market. So it's an interesting picture to kind of compare all three of these. The thing, again, that stands out to me is geopolitical risk, and we'll talk about that from a headwind perspective in just a second, or an obstacle, and then valuations too, which we will touch on as well. I'm not going to spend a ton of time on this slide, so this is just essentially an indicator of leading economic indicators or activity. And so what we're just looking at, where we saw all those different types of indicators, this is basically taking all of those and saying, how do we build basically a chart or graph this to help us kind of see what this looks like? So we're looking at this over, since 2000, so about 25 years of history. And you can see it's done a really good job of predicting the last 3 recessions. We saw it showing in the shaded area in 2001. We see it in 2008. That smaller stint there when we had COVID hit in 2020. What's interesting to note on this is, kind of gave a false signal in 2022, 2023. So it's not perfect, and I think that's important to mention. You guys may not be able to see it, but we are starting to kind of creep up just a little bit on the graph, which, looks good. Time will tell. I think we're too early to tell whether, that has legs and continues, but it's something we're watching, something we pay attention to, something that probably bores you guys to death, if we're being honest, but I get excited about it. So let's talk a little bit about headwinds. I think it's important for us to say, okay, we're in the middle of this race, we're running it. What are some of the obstacles? What are the things that we need to be looking out for? And, most of these probably don't surprise you guys, but I think it's important to mention, if we were to see inflation picking up, that's definitely going to be a headwind in the market, because if you think back on where the chart that showed the S&P performance on an annual basis, we saw benefits to inflation numbers coming down, and that really kind of propelled the market forward. So if we were to see a resurgence in inflation, I think that would be some cause for concern. Jobs are important. So the labor market weakness is something that we do need to be paying very close attention to. If that were to weaken, Chris, I think we get probably some recessionary pressures if something like that were to happen as well.
And I will say the thing that's going to be interesting specifically with the labor market, obviously we're seeing right now, that job growth the past number of years has been primarily government employees as well as healthcare, which is highly correlated with government as well. So it's kind of got this high correlation. So it is going to be interesting to see what employment numbers look like, because we are seeing obviously a lot of government employees either taking a buyout or being furloughed and all of that, and what that impact is going to have against the numbers that we've seen over the past couple of years, kind of keeping the labor market pretty strong.
Yeah, and potential headwinds, it's been on the list for the last few years for us geopolitical tensions have been on the list of headwinds, because it definitely remains a concern. It's something that we have to be mindful of and pay attention to. It's not going away, I don't think, anytime soon, unfortunately, but it is something to watch out for. So, all these headwinds are not good for growth in the market, and again, are things that we want to prepare for, and we'll talk a little bit about, a couple strategies here in a bit of, one, how we're kind of making some adjustments to sort of counteract some of these potential things, but also a strategy or two that I think bodes well, in this type of environment, especially as we move into this year. So again, on the flip side, tailwinds, good for growth in the market, good for growth in the economy. You guys have all heard it, but AI, that continues to be the buzzword, buzzword of last year, and I think continues to be important this year. One thing that's interesting with AI, there's what I consider to be kind of like first order or first layer effects, second layer and third layer. And I'm going to talk about specifically some adjustments and changes we made in some of our prime models to gain exposure, not just to the first layer, which would be, I invest in NVIDIA or I invest in Microsoft, companies that are very directly related to AI, but also thinking about what really you need to drive AI moving forward, which is energy. You have to have energy to make AI work. And so really trying to focus on like a second or third layer effect that says, well, let's invest in infrastructure, energy infrastructure that is needed, for continued development in AI, is kind of a way to diversify but still have exposure in that space, which I think is really important. We'll talk a little bit more about that in just a bit. Rate cuts, monetary easing. I think again we probably get 0.25% rate cuts this year. That would be positive. Again, think the goo gels on the race course. It gives us a boost, and I think that would be positive. And I mentioned earlier, corporate earnings, which that's just essentially earnings. In the stock market. The expectation this year is for about 11 to 12% earnings growth. And that's for just broad market, broad S&P. And so far we've been hitting those expectations, which have been great. I do think it's really important for us to continue to hit those expectations. If we start seeing those numbers dropping a little bit, not meeting expectations, that would be cause for concern.
Well, we've seen a little bit of that.
Yeah.
Like Walmart, obviously, last week
There's been a few.
It missed. I think Rivian. I saw that they got hit pretty hard. So I mean, that's what my eyes are trained on right now, which is, where are people spending money, and are we starting to see people missing in those areas? And that's where some of the concerns come in, and where we're pivoting as well.
Yep. Not going to spend a ton of time on this, but we were talking about valuation, and this is a chart that's just measuring the S&P 500 and its value, or its valuation measure. So it does it for based on price to earnings, and that's just saying, well, what's the price of the S&P, and then what are the earnings, and it's just taking those two numbers and dividing it. So and then it's graphing it on this chart.
And basically, what this shows is if you're above that middle line, you're overvalued.
Yep.
And if you're above that top line, you're pretty significantly overvalued. And that's one of those things when you hear like the market's frothy, or you might remember back in like the late 90s, early 2000s, Warren Buffett said the market was irrationally exuberant. That's what we're talking about, is when the prices of stocks aren't necessarily supported by what they're generating. Now here's the thing. That's usually how you judge a stock, but have we ever, any of you in here, bought something above market value simply because you wanted it? I know my wife has. I've never done that, but she has. But I mean, I think we see that in the market as well. There's going to be some things that the market just drives forward. Again, I'd say AI, where you don't necessarily see the return on that right now, but you're definitely seeing the valuation drive on.
Well, and I think the important thing to remember with this too is this is taking into account all the very expensive Magnificent Seven companies. So your NVIDIAs, your Microsofts, your Apples. If you take those away, right now we're looking at around a 22 price to earnings number. If you take those away, the number's closer to 15. So closer to that kind of 30-year average, which makes a big difference. So not to jump the gun, but part of what we've really been trying to be strategic with in our portfolios is to say we still want we want allocation to those big mega cap companies. The Microsofts, the Apples, the NVIDIAs. They're not going anywhere, but they're kind of expensive. So just being mindful of exposure and what makes sense, and looking at other parts of the market that is not quite as expensive.
And I do think NVIDIA is a great example. A couple of weeks ago, any of you that follow NVIDIA, I mean, we've obviously seen it skyrocket, right? And that gets exciting, but we also got to see how quickly some bad news against NVIDIA just tanked the stock over a fairly short period of time. And that's the one thing, again, the reason why we do what we do is we want to make sure that we don't have any of our clients, that you guys have worked hard for what you have, being overexposed to something unnecessarily for risks that we don't control. And when we see something kind of ballooning, everybody wants to say, let's go all in. The problem is we don't know when that balloon's going to pop. And if you, again, go back to the .com world, we remember when that balloon popped, right? And boy, that hurt. And the problem is sometimes people are all in on one or two things, and that destroyed plans. So we don't want to be in that same scenario, right?
Yeah, we want to be smart about over allocating and exposures. So let's talk a little bit about what we expect in 2025 and really where we see things heading. And I talked about this, I mentioned this earlier, I'm going to come back to it, but earnings are really important. And so, what we're looking at here is just a graph of where we think earnings are going quarter over quarter. The good news is we're seeing good positive growth, and that's the expectation for earnings moving forward. And that's kind of what I was pointing to. We think overall we're looking at about 11 to 12% earnings growth. And if we hit those earnings growth expectations, we're going to be just fine in the market this year. But that's really key, is just seeing where those earnings are falling and how they're coming in quarter over quarter. Inflation and interest rates, continue to be big drivers in the economy and in the market. And there's a lot here on this slide, but really what this is just telling us is by the middle part of the year, we're expecting at this point, about a 50% probability that we see a 0.25% rate cut by the Fed. And again, that could change. This is a very fluid projection in terms of how they calculate these probabilities, but that's where we're at currently at this point in time. And I'll just briefly touch on this, from the standpoint of where we see growth, specifically GDP growth and the unemployment rate, jobs. Again, those are two really big data points that we want to be paying close attention to. You can see, towards the end of the year, the last 2 quarters of 2025, looking at pretty decent GDP growth, not knock your socks off
Now make sure
growth.
people know what GDP means.
Yeah, gross domestic product.
And what does that mean?
Yeah, so I mentioned it a little bit earlier, but it's production, right? It's just the amount of goods and services that somebody's producing in a given quarter, country, given quarter, whatever the time period that you're measuring it. So it's the production that we're seeing the growth in an economy. Unemployment rate, again, I mentioned we're starting to see that number inch up a little bit. 4.2, 4.3% is still pretty low, from the standpoint of where we've been in the past. But it is something to pay attention to because we have seen that creep up. But that's really where we're looking at, or where our expectations are from a growth, from a labor market perspective. What's interesting when we look at, again, where folks are pegging the S&P for the end of this year, it's somewhat of a consensus, and again, in that kind of 6,600 range, which puts us around, I would say high single-digit to low double-digit growth expectations. That is somewhat in line with historical data when you look at first-year new presidential cycles and kind of where the averages fall. It's around that 9 to 10% range for the S&P. Now, average is dangerous, right? Because you never want to forget the man who was 6 feet tall who drowned crossing the river that was 5 feet deep on average, right? So you got to be real careful about averages. But the data and again the earnings forecast does point to about, again, I look at it and I think 10-11% in the S&P is pretty likely if we see inflation, labor market, and earnings expectations staying where we think they should stay.
It's a big if.
It is. Now, we talked about this last time. I really like this slide, and as I'm kind of wrapping up, I'm going to talk about this, and then I'm going to transition to a couple of our portfolios that I think I just want to highlight a little bit about. But before I get into that, this slide to me, Chris, is just so important because it's a simple slide, but it really speaks to the value of a consistent approach, a consistent investment approach over time. And we're looking at really the percentage of positive versus negative outcomes over a 1-year period, a 3-year period, 5 and 10. And to no one's surprise, the longer we're invested, the better the outcome from a return perspective. And it just kind of points to, again, I just think about the value of a consistent approach. Not trying to dance in and out, not trying to get too cute, but just making smart, proactive choices and adjustments.
Yeah, and there's all those, there's the studies that talk about, when you get too jumpy in and out, it's losing, oftentimes you're locking in your losses on the downside and you miss the upside, which if you do that consistently, then you essentially get punched in the stomach.
Right.
Every time you stand up, you get punched again, and it's a repeated process.
Yeah. So let's talk a little bit about, I want to highlight 3 portfolios. And the first slide that I have up here is a slide that depicts our prime portfolios. Now, I kind of think about our prime portfolios, our prime models, really at kind of the core of what we do, very foundationally core to what we do. All of you in here most likely have an allocation to either a prime model or an income model that we utilize. And I mentioned earlier, but one of the strategic adjustments that we've made in our portfolios is allocating towards the incremental demand that we think we're going to see from the power grid, in energy infrastructure, and saying that's a train that's on a course, it's not going away, and so we want to make sure we have a smart allocation in something like that. And we're not going to over allocate at the end of the day, but we do want to have some exposure there. Secondly, in some of our more moderate, conservative investment models, prime models, we've made a allocation into a long-short equity allocation. And I know I'm getting into the weeds a little bit. Look, Chris is over here about to get...
Yeah, no, I was starting to get antsy. You got to let people know what... So long, short.
Yeah.
I mean, you want to... Long just means that you're buying something with the perspective that you're expecting growth and you're positioning it to go up. Short means you're actually taking a position.
You make money if the market...
Make money if it goes down. and it's more of a protective measure. So a long-short strategy kind of almost goes a little bit for that average we were talking about.
Well, it does well in a market that's very volatile or more volatile, and that's kind of what we're expecting this year. And to Chris's point, it doesn't do as well in a market that just rips, but it also, probably doesn't do amazing in a market that just tanks. But in an average environment, we think we can add some value there, and that's really the idea. It's still long biased, meaning we're more long than, I know I'm getting way in the weeds, we're more long than we are short. But the idea is, let's try to bolster the downside if the markets do fall, but let's still give ourselves some really good upside potential if the markets go up. And I'm very positive on that. I think it makes a lot of sense for us this year. We'll see how the year progresses, and if things change, we'll adjust.
The way I kind of look at it, and it's probably not the best example, but it's if you go to Vegas, somebody had mentioned their kids just went to Vegas this past weekend, but it's splitting your bet on red and black if you're at the roulette table. But if you really are confident that it's going to be black, then you're going to go heavier black and less on
And that's
red.
why we're heavier on the long side, because over time the markets go up, and so we want to make sure we're smart about how we're invested. But yeah, it just gives us a
little bit of a
hedge against market volatility.
It's a form of diversification that, quite frankly, didn't exist in the past.
Yeah.
Right. It wasn't accessible to individual investors.
It
was something that was only held in things like a hedge fund or very exotic. And the nice thing is now there are ways to position it to have a protective measure for investors.
Yeah.
And again, when markets get volatile, you want to have that in there just to have a little bit of that downside protection. You're going to give up some upside with that, but we feel that it's worth it at different times if you get a little bit more volatile.
Yeah. This next slide is just a depiction of our income models. And again, this is a stock bond allocation, but the focus here is on income generation and less about just capital appreciation. So we want to be focused on generating income, generating a yield that can support whatever it is we need to support. But the focus here is on income. So we've talked about the prime models. I want to take some time to talk about two different targeted investment strategies that we have access to, and we've really worked hard over the years to kind of build out some options for us to complement. And I think about these as complementing our prime and our income models, but we've got targeted income strategies and targeted growth strategies, and they can take different forms and different shapes, but I just wanted to highlight two strategies that I think make a lot of sense, in this type of environment. One of them is, more focused on really tax efficiencies. So our dynamic tax efficient select strategy is really interesting. And I think for non-qualified accounts, so taxable accounts, it can make a lot of sense. And really the idea behind it is, we track a benchmark. So we say, let's track the S&P 500. That's, the most widely known. So let's track the S&P. But instead of tracking the S&P and holding like a fund, like SPY or whatever the Vanguard fund is, VOO, let's buy some of the actual companies of the S&P. And now that we own the companies, we have the ability to manage it very tax efficiently. So we all know the market, all holdings in the market doesn't always go up 100% of the time. And so we have the ability to say, well, if some stocks are down, we can harvest losses. We're still going to track the benchmark, but then we can use those losses to offset gains in other areas of the portfolio. So it's a really unique strategy. It can really add value in a market that's pretty volatile, which is kind of what we're expecting this year, more of a volatile market, and that's one that I think makes a lot of sense.
And if I want to highlight this one because I do think that this is very important for so many of our clients that want to have tax efficiency that have non-retirement accounts. Because when we use ETFs or if you use like mutual funds and things like that inside of those accounts, you're subject to kind of the taxation that happens inside of those different things, and it's very hard for us to manage around that. But with this specific type of account, it allows Jacob and the team to, again, hold individual investments that mirror what the broader markets are doing, but then it gets really fun because they are able to take advantage of tax loss harvesting and processes like that, and it becomes a lot more built specific to people that have wealth built up. If you're 25 years old and you're not really worried about taxes and you're worried about socking money away, great, you can throw it into to something that's not super tax efficient. But when we're talking about creating tax efficiency, and I know this has been a big conversation you've been having with more and more clients, it's just a way for us to be very, very intentional going forward about taxation on your non-retirement accounts.
Yeah, that's well said. The last strategy that I'll mention, and then I'll kind of wrap us up and hand it back over to Chris, is dynamic growth strategy. And this strategy is certainly suited, I think, best for folks who really want to see outperformance. Outperformance of the S&P in general. And it's got a great, proven track record of success, but it's a very concentrated strategy. We're going to hold about 15 to 20 individual companies, so it is very intentional in what we're doing. And we're looking for companies that have great profitability, great management teams, good, strong free cash flow, just good companies all around. But the key is we're really trying to identify companies that are kind of disruptors, in their space, in their respective industry that they operate, because that's kind of where, if you're good at what you do, that's where you tend to see the outperformance, the alpha factor. And that is one that, I think can complement, in different areas, again, kind of our core prime or income type focused investment strategies.
Yeah, and again, to touch on that, this is, one of my favorite portfolios just because the intentionality behind finding the things that are going to have the greatest level of growth. With greater growth, you can also have some greater risk, and I want to be very clear. But something like this type of portfolio, it's not super tax efficient. It's not built to be that way. But if you've got like a Roth IRA where you're not worried about taxes, this is a great portfolio because this is an actively traded portfolio. And inside of a Roth IRA, one, you can get good growth off of that Roth IRA, but taxes aren't a factor inside of something like that.
Yeah.
So that's where I really see.
Yeah, leveraging it in a Roth makes a lot of sense because of the benefit from a tax standpoint in that growth.
Even inside of a traditional retirement account, because of the trading, you don't have to worry about some of the short-term capital gains and all of that type of stuff. And it's a true growth focused, and it's also fun because it's a handful. It's 15 to 20 individual stocks. And I always think of my dad. My dad loves to see his individual stocks, and this gives him 15 to 20 different things that he can really focus on. In fact, this is something that for my girls, we have little portfolios for them, and this is my favorite thing that they have because it gives Dad a chance to have conversations about individual stocks with them as well.
Yeah.
Blythe asked me the other day, she's like, why do I own Netflix, Dad? Now, granted, her holding in Netflix is about that big, but she's like, I don't think anybody's watching Netflix anymore. She's 12 years old. But here's the thing. That was for a guy that's in the financial world, that was the coolest conversation I started having with my daughter because she said, Dad, can we actually buy some more Amazon and Coca-Cola? Those were her two. And wasn't real excited about the Coca-Cola because I know why she likes that, but anyhow.
That's exciting. So as I wrap us up, at least for this part of our time today, I actually want to bring us back to the hills of West Virginia. That's where Chris and I ran the race, in West Virginia, my home state. Don't hold it against me. But it's funny because I was thinking about when we were looking at the map, right? We were preparing for this race, and when you have this idea of how the race is going to go in your head. And then you get on the course, and it's a lot different than what you expected. And the two things that stand out to me, I'm running, I'm trying to get done as fast as I can to beat Chris. To beat everybody right now. But I wanted to hit a certain time. I wanted to get done as quick as I could. And there were times when I had to make adjustments. The two things that stand out again, I got a little dehydrated a couple times. And I was like, I had to stop. I had to get some water. I had to take a second, kind of reorient myself, and then get after it again. The second thing that really stands out because it was painful, is you start cramping up. You're cramping, your legs are cramping, my calves, and you have to stop, or at least I did. I couldn't push through that. And you got to stretch, you got to get water, what have you. And so, hopefully you're seeing the similarity, right, of we're running this race, and we've got to make changes along the way. We've got to make tactical adjustments and allocation changes, just like we do with our portfolios. And that's what gets me excited. I enjoy it. It's a process that's not easy, but it's something that we don't take lightly. So we thank you for the time today. I thank you guys for coming out and for allowing me to talk a little bit. I'm going to hand it back over to Chris now.
There's a slide for his presentation. But the next segment we're going to have is we're going to actually have the Hey Hobart segment. Now, the Hey Hobart segment is, again, as I'd mentioned before, it's where we take questions from our clients and from folks around the Charlotte community around different financial planning topics or different concerns that you might have, and we just give you our perspective. So what we're going to do is Bob is going to be, Bob's our COO. He's going to be the one that's leading this, and then we're going to have Andrew, Nick, and Corey, who they are our wealth management or our wealth advisor team. Come on up, guys. We're going to have them get up here. Now, again, if you really want to see how short I am, you put me next to this guy. Just as they get up here, the worst presentation that I ever gave was there was another guy that we presented with one time. He was with another company, and it was Chris, 5'10", Andrew, 6'5", and Pete was 6'9". And I had to stand in between the guys during the presentation. I got to tell you, I felt like the littlest guy in the world. All right. I'm going to hand this over, guys. Impress the crowd with everything. We are going to have two folks running around with microphones. So if you have a question, I think Bob might have one or two to prime the pumps with, but if you've got a specific question, they'll be running out to you. Bob, I'll let you take over.
Thank you so much, Chris. Chris is teasing about being short. I stood down here so I don't even have to stand next to these guys, okay? But yeah, let's go ahead and if you got a question, feel free to raise your hand and we'll get the microphone to you. I have the privilege of being with these guys in different settings and getting questions a lot from different crowd members and different groups with regards to what's going on in the financial planning arena. So let's kick things off a little bit, because one of the things that I really find difficult in our business is so many people we meet are used to a financial advisor only managing their investments and only focusing on the account that they're getting paid to manage. And I want to ask the first question of Corey. He's our Director of Financial Planning. Corey, just give a sense, if you could, what are you seeing as folks come into our office that are new to the firm? What do you think they see as the difference between a comprehensive financial planning approach and just focusing on investments? And how do you talk people through that?
Yeah, I mean, that's pretty common to have people come in who are just so used to speaking with a planner or a financial advisor that has just focused on the investment accounts they've had over time. Most of the folks that walk in the door, none of us are, in our daily life, we worked all this time, we contributed to our careers, we worked really hard to earn the money that we have, and along the way, believe it or not, we did not become estate experts or tax experts or investment experts, which is why we have a job in the first place. Most people that come in from a tax perspective have very little knowledge about what's going to happen in retirement. The reality is, once you get to retirement, the tax picture gets more complex. So you'd think things will get easier and simpler when you get there, but when you talk about Social Security and Medicare and all the money that we've got in our IRAs and everything else going on, it tends to be a bit complicated. So we love walking through people through the motions of how to save money either today or in the future on taxes. And the estate planning piece is big too. I mean, you'd be surprised at the number of people that come in the door that don't actually have a will, power of attorney, a basic estate plan set up, or those that have one set up that is just old and outdated. So we love the opportunity to look over that stuff outside of just the investment accounts to make sure that all the little screws in the plan are tight.
Yeah, very good. By the way, if you've got something, raise your hand, and we've got two microphones that'll come to you. Let me ask this question, Joey, as you come over here. Let me ask this question of Nick. I wanted to make sure that you see Joey here tonight, and you see Michaela, Nancy's here, Doris is not here though. But these dear folks, one of the things they can do for you If you've never had a chance to sit down and have someone show you, you can do it from your home, looking at your computer. If you've never had our team show you what your own personal financial management website looks like and how that might be a tool that you can use and that would benefit you as you keep track of your financial plan, please let us know. We'd be glad to help you with that. Nick, you do a great job of taking folks through that and giving them a tour. In your experience, what have you seen is most helpful to that website for the average client that you work with?
I would say it's just asset aggregation, right? When we talk about holistic financial planning, it's hard sometimes when you're talking about Schwab accounts and annuities and maybe a 401k or your bank accounts. Sometimes it's hard to see all that in one place. eMoney is the site that we use. It's a good aggregator for that. You can even link things like your spending access that you can help kind of with your individual budgeting needs. And it's also an online Rolodex, right? You can put all of your real estate attorneys, your CPAs, you can put all of that in there and everything is in one nice, secure place.
Yeah, I love that. And it's a great estate planning tool in that, God forbid, when something happens to us, now who's ever handling our affairs can go to one place and find everything they need. I've even had clients put a note in their vault that says, "Open me first." Because when the day comes and they pass away, they want their children to open that first. Joey, you got a question back here? Was there someone with their hand? There you go.
Thank you. I just wanted to ask, when Jacob said that in one of the funds they do long and short, what kinds of things are they investing in with those portfolios?
Yeah, no, great question. Do you want to take that, Andrew?
Yeah, I could take that. Hey, Julie. So long short is a fund. So it's an ETF, exchange traded fund, and within that, and not to get overly complicated, but the technical aspect is more along the lines of options trading within that, utilizing options within the S&P to leverage both a long position or potentially a short position as well. We have something similar in another position that we've utilized for the past year plus in our buffer strategy as well. Buffer was actually what we sold shares out of to free up funds to purchase the long short position. But again, without getting overly technical, it's a utilization of options within the fund itself.
Does that answer your question? Very good.
Where did Jacob go?
Anybody else? All right, very good. Yes, sir, right here. Ma'am, I can't see, the lights are too bright. Thank you, Michaela, I appreciate that.
Hello, hi Nick. You can answer this for the crowd and not me.
Okay.
How often would you all recommend that we meet with our wealth advisor, and or are there triggering events that you would go, hey, that's worth you coming in and let's discuss in person?
Good question, Martha. And then Michaela, there was one inside the middle there a little bit.
So yeah, I mean, it's very important to meet on a semi-regular basis, and it will be different for everybody, right? I mean, depending on what your needs are, we may need to meet more often. If we're using maybe one of the more complex strategies, that's definitely going to necessitate us keeping you up to date. And you mentioned it perfectly. Any kind of triggering event, right? We've got your information. We're doing the reviews. We've got the plan, and we're running with it. But we don't know what we don't know. Right, so if something does happen, be that a death, a birth, right? If you want to add a new account for a grandchild or something like that, retirements, anything like that that's not something that normally happens, just reach out. We're more than happy to get a time together to go over that and see how that affects the plan.
Yeah, it definitely is so client dependent. There are clients who basically take the approach that I don't want to necessarily meet with my advisor unless there's a need, and others want to check in regularly and make sure everything's still tightened and buttoned up. And so we really follow your lead in that regard with regards to how often that needs to happen to really satisfy your requirements. But all our advisors are scheduling on a regular basis those meetings and when they're going to reach out to you. So if you want that schedule to change, by all means, let them know.
Bob, can I add to that real
Please,
quick?
yes.
Like just some other things that come up that are age-based that will cause you to probably have questions. So when somebody turns 59 and a half and they can, withdraw from retirement accounts at that age, 65 is when we do what? Take Medicare. Social Security is all over the board. If you're thinking about taking Social Security and you don't know whether or not you or your spouse should take it, that's what we're here for. Age 73 now for required minimum distributions.
70 and a half.
70 and a half for charitable gifts. There's a lot of age-based dates that maybe they apply to you, maybe they don't. But inevitably, when somebody hits that point in their life and it's a small little part of their financial life that has to change, they're going to have questions. We can answer those naturally through the account reviews that we do with you, but also pick up the phone, call us, or email us. I mean, we're always happy. Not everything has to be a full meeting. Sometimes we can get that question answered in 15 or 20 minutes, but that's what we're here for. So.
Yeah, really good. Listen, these guys are there to answer those questions. We had I met with one of these guys with a dear lady who came in recently, and I think it was Corey, asked her, when are you thinking about taking your Social Security? And she kind of punched the table and said, I'm going to take it at 63. And I think Corey said something like, tell me about your thinking on that. And she said, I don't like giving money to the government. I'm sick of giving money to the government, and I want it back as soon as I can get it. And she said, now tell me if I'm doing something stupid. And the truth be told, he had already done the analysis, and with her particular plan, that made some sense, and it was going to work out fine. And he said no, and he gave her license to do that. She said, now tell me if I'm doing something wrong. And he said, I promise you, I'll tell you if you're doing something wrong, but I think that'll work fine for you. So when you've got those questions, pick up the phone and call. Who else?
Good one.
Is it ever wise to think about paying off your mortgage if you're 75 years old and looking at what the future might be under this new administration and thinking that stocks might really take a big dive?
Yeah, I'll start with this.
Go
one.
ahead.
I'm sure we can all add something to this. This is a very common conversation that we have with any client, any guest that comes into our office that still has a remaining balance on their mortgage. And the way I like to approach it, I can wear two hats with that conversation. I can wear my mathematician hat, which would simply look at things from an unemotional viewpoint and say, all right, well, what are you paying to borrow the money? What are our investments earning over here? And as long as our investments are earning more than what we're paying to borrow the money, there's your solution. Now, that's a very cold answer, but there is some truth behind that. Now, again, this is all very situational based on what you're dealing with. 75, age plays a role in that. There's also the friend-to-friend hat that I like to put on after I'm done, running the numbers. And I've seen it enough times where the peace of mind that having your home or whatever the debt that we're talking about, having that paid off in retirement, even if you're borrowing money at 2.5%, if it's something that you are dead set on accomplishing and that's a goal and it's going to bring that type of relief to your situation, then we're going to run the numbers, we're going to show you the difference, and we're going to go about it that way in an informed manner. But again, I like to wear both hats and just say, hey, this is one way of looking at it, this is the other way. Neither are right or wrong. It's all very situational, and it's what's going to make the most sense for you. You do bring up a good point, though. Borrowing rates today are much higher than where they have been over the last few years. The days of 0% borrowing, I think that's behind us. We'll probably never get back to that. If we do, that probably means something has broken along the way, so let's not hope for that situation again. So we are at a point now where, 30-year mortgage is 6.5%, 7%. It's a much different conversation with clients than it was even just a year or two ago. So, not sure if you guys would add something to that.
I did hear a part of that comment about the question, though, that I just want to make a point about, and that relates to, I think, just in any new administration concerns that come up, like what is going to happen with whatever administration is in place. And I think the thing that we have to concentrate on as it relates to the value of our homes, the stocks and the investments that we're in, the taxes that we pay. Look, every administration is going to have a different impact on things, but we in our office, when we're helping you make financial decisions, we have to do that based on fact, what we know. And I think the reality is whenever we shift into a new administration, there's a lot of things we don't know. And we're a month into this right now, and sometimes maybe it's a little bit difficult to determine what's hyperbole and what's reality. But for us, we try very hard not to emotionally react when we walk in the office to those things. That's our job. And so when it comes to investments, Jacob is paying attention to the facts and the numbers that he's seeing coming through on a daily basis. We're paying attention to interest rates and whether or not there are going to be any tax changes in the foreseeable future. And we have to make decisions based on what we know, not what we speculate all the time. And so I don't know that there's any, I don't know that the new administration necessarily influences whether or not we'd pay off a house. I think that's just a little bit more personal of a conversation that has to do with the market and somebody's personal situation. But I know it's hard. The headlines come out and it's hard not to react to them, but we really have to just be patient and kind of see how things play out before we start making big financial decisions based on that.
I would also say it just comes down to the source of the funding too. Like would we pull it out of an IRA and get a double, big tax hit that might trigger IRMAs, things like that? That definitely tips the scales towards no. But if you're talking about, an inheritance, a windfall, something that we're not actually pulling from an actively invested source, money that you weren't expecting to have anyway, then that also changes the conversation. So it's just so situationally dependent.
Ties back beautifully to the earlier question of when do I call my advisor? That's a great question to call about because those situations change. Interest rates change, the market changes, your feelings about the situation changes, and so that's great stuff to call about. Anybody else? Questions? Yeah, we got 2 here and 1 there. All right, very good. Michaela, do you want to come over here? Thank you, ma'am. Go ahead, ma'am.
I just want to tell you how much it means to me that y'all are by my side. I know everybody in here probably works with Hobart, but if you're not, you're making a mistake because y'all are absolutely wonderful. I'm 73, so I'm going through the IRA thing where you got to get rid of some of your IRA money and all that. And I would be lost. I would be completely lost. And I want to just tell you how much I appreciate all of you and your support. You're wonderful.
Thank you so much. Thank you.
Thank you, CP. That's very nice.
Yes, sir.
Maybe you can explain to me, I'm confused. I seem to live in 2 different worlds. When I was growing up in the 50s, the country was very stable, and interest rates were normally 5.5%. It wasn't any big deal. Now, there's so much change going on, and if interest rates go from 2 to 3%, my God, it's like the sky is falling. What has changed that has made, normally 5% was the way it was, and life went on very stable. Now, if you have a 0.5% change in interest rates, my God, everything is thrown into flux. What's different between the time I was growing up and now?
So I think it's a couple of things. One is recency bias. And by that I mean, since 2008, rates have been rock bottom. And so you're talking about now approaching 20 years of low interest rates and an entire generation that has never experienced rates like we saw in the 80s. So when things start going up, people react a little bit more. There's also this thing called media. I don't know if you guys ever heard of them, but it is just awful the amount of headlines and fear that is pumped into the general public about this stuff. So there's nothing that's not a headline these days. And so I think that's another part of it. But if you actually peel it back and kind of look at borrowing as it relates to home buying and home purchasing, the reality is today, it's not only the interest rates that have gone up, but it is the price of what a home costs compared to the incomes that America is pulling in, and the cost of homes have increased exponentially faster than incomes have increased. And so then when you lump, a 5 to 6% interest rate on top of that, while it's not bad historically and actually it's pretty average, it feels so much worse because post-pandemic, housing shot up because a bunch of companies were out there buying residential real estate and kind of moving the prices up, and interest rates stayed very low and people had capital. And so I think it's a culmination of those things that make it feel different.
It's well said. Remember when we were younger, a single income family, moderately, modest income could afford a mortgage. And today it's quite different. Excellent. Somebody else. Yes, sir, please.
You all agree that you can't time the market. If you inherited a chunk of money that wasn't invested, is it better to invest over time like they suggest, or put it all into the market all at once, or put it into a funds all at once?
Yeah, great question. I think it depends, but Andrew, why don't you give a shot at that?
Yeah, I mean, we'll find out 6 months, 12 months from now, right? I mean, you bring up a good point. I mean, the textbooks would suggest to us, and it's something we're all very familiar with. Most of us have worked in the corporate environment where we're offered a 401k plan, right? 401k, 403b. And one of the beauties involved in those types of plans is the fact that it's kind of forced contributions. It's out of sight, out of mind. We're not instructing anything to happen. And what's actually happening is we're buying the market on the dips, we're buying the market on the upswing, we're buying the market all throughout. And what we're doing at the end of the day is dollar cost averaging, which is kind of, I think, the point that you're getting at. But ultimately, depending on the time frame that we're talking about, it's going to depend on what the market does in that time frame. But I do think that depending on the size of the inheritance, depending on what we're going through in the market, depending on what your unique goals are, that could allow us to say, all right, well, in your situation, let's take $10,000 a month and let's buy, into the market, or let's say whatever the number is, and go about it in a coordinated fashion. In other situations, depending on what your goal is with that money, maybe you have something planned for that money 12 months from now where we don't necessarily want to risk the money. It could be a completely different strategy as well. So yes, the market is going to ultimately tell us over time what the best solution will be, but depending on what your goals are, again, could lead us to, going ahead and biting the bullet and throwing it all in, or taking a more cost basis approach to it, or dollar cost averaging approach.
I had a situation about 4 years ago where a new investment strategy came out that a lot of people were interested in. And I think over about a 2-month period, 25 of my clients went into this strategy. The vast majority of them just lump summed invested into that strategy, but 1 or 2, I remember, wanted to delay a little bit each month and dollar cost average in. In that situation, in that timing of the market, it didn't make much of a difference for any of them in the end, but it could have. And so there is a preferential point of this as well in what someone might appreciate. Very good. Who else? In the back there. Yes, please.
First of all, I'm 4'11", so height is relative. Somebody else is always taller. But you mentioned before that we're looking at a volatile market, or that's the way you were thinking about volatile market. Yet you also mentioned that you don't speculate. You had to speculate somehow. When you look at last year, it's based on everything that was put in place by a prior administration. A lot of that's been cut, changed, whatever. What do you use to look at moving forward?
Yeah, no, great question. And Joey, come on up front here. We've got some more. I'm going to let Nick answer this, but we've got a wonderful chart that Jacob has shown in the past that shows during the year, and we're really in every year over the last 30, how far did the market drop? Somebody up here had their how far did the market drop during the year, and then when did it end up at the end of the year? And what that chart really shows is there were a lot of times during the year when people could have freaked out because the market was down, but it ended up at the end of the year decently. So it's those short-term volatility, that inter-year volatility that we don't want to be trying to time and play any games with, but look a little more long-term. What would you say, Nick?
No, I would say that's definitely the right train of thought. And we tend to think of the market as this kind of amorphous thing that we can't really wrap our minds around. It's just the companies that you and I use every day. And so what sectors of the market, we're not trying to time things, but if we expect more volatility, maybe using more dividend-paying stocks that historically have not seen some of the massive ups and downs. If you look at a company like AT&T and compare it to a company like Verizon, right? Verizon is going to, over the long term, probably have grown more, but it's also going to get there through much sharper ups and downs. And so if we're expecting more volatility, maybe it makes sense to move some of our funds into something that's a little less volatile, that has, pays a dividend, that we can, to Andrew's point earlier, use to kind of dollar cost average in. That's also where we might look at bonds. It just kind of depends. So we're not necessarily speculating on what exactly is going to happen in the market, but we can look back into history, see what certain circumstances have led to certain things, and then try to shift within the sectors of the market, and maybe even within different accounts, right? So if we're talking about risk, we look at it on a holistic basis. Maybe it makes more sense to shift some of that risk into the Roth that we know is long-term money that we can gain a little bit more from with the tax-free earnings. So that's one strategy as well.
Let me add one more thing to that, and then we'll turn it over to Curtis. So again, not to go political, but we've seen this administration before. We've seen the playbook before, right? We've kind of forgotten over the last 4 years how it sounds, how it feels, what it looks like. But we've seen this before, and we've seen initiatives, we've seen policies, we've seen legislation, we've seen where the money goes. So again, energy, industrials, the financial sector, small cap, mid cap. Again, these are bets, if you will, that we're making on the market, speculating, if you will. But again, there's data backing these decisions to where it's not just throwing darts at a dartboard.
Right. Remember, folks, we're tweaking all the time. We're talking about the markets daily. We're meeting about our investments at least monthly. We're at least tweaking and adjusting quarterly. And so we might be moving from one style of equity to another and making those tweaks and adjustments. When we talked about timing the market, we're talking about jerking in and out of things. And that's why if you look at it over a long period of time, the market's done 10% growth, but the average investor has made 4%. And the reason why is we try to time it and get out at the right time and in at the right time, and that is, like it is said, catching a falling knife twice. Yes, sir.
Some portfolios are more heavily weighted towards qualified retirement funds and others towards brokerage accounts. And I'm sure there's challenges in both, but which ones do you find more enjoyable to manage?
Roth accounts. Yeah. Because we get to be, they're the fun ones to watch, right? So we typically are a little bit more aggressive in our approach in Roth accounts because we know that those returns are going to be tax-free when we get them. And so that's what we call asset location. We want the right investments in the right accounts. So, you look at the Roth accounts that are mostly aggressive over the last 2 years and we're all high-fiving each other like, this is great. But there's other I love being able to look at a brokerage account this year so far and see that the market's up and the account is up, but we've also been able to harvest losses from a tax perspective in there. But excitement-wise, I think everybody in this room would say we all love when the market's positive and it shows itself. I don't know if that answer would be any different for you guys, but.
I think I like the brokerage style because there's a silver lining to down markets, right? When we're talking about going through those down markets, and they will happen, that's a given. In an IRA, it just doesn't feel good, right? We just kind of have to watch. But in a after-tax or brokerage account, there's things we can be doing. We can do some capital loss harvesting. There's some tactical items we can do. So I think that one, as far as just from a kind of a chess game, is one I enjoy working with.
Very good. Guys, thank you so much. These have been great questions, and I know